Estoy encantada de estar aquí con ustedes. I am the CEO of a research house specializing in the fund industry, the UK fund industry. I'm here today to tell you about what life has been like under the new regime in the UK, the RDR, which shares some characteristics with MiFID II. You will undoubtedly have plenty of questions, which I will be happy to take after my presentation. And the conference organisers have set aside quite a bit of time, so please do not hesitate to ask questions. I've created a series of 3 films for you, which I will let play, which is a bit dangerous as it's like driving a car without a steering wheel. So let's go back to the beginning and to understand what the FSA was trying to achieve with this new groundbreaking legislation. The regulator had a number of concerns that it wanted to address. The first was that consumers like you and me did not have sufficient clarity and transparency on the products they were buying. It was also concerned that a large number of consumers did not get access to good advice for their financial needs, whether that was pension planning or saving for a rainy day or putting money aside for the children's school or university fees. At the same time, the regulator wanted to break the influence that manufacturers had on product selection. Last but not least, the regulator wanted to make sure that all advisors were trained and qualified to a high standard. But before I launch into the detail, let me give you some facts and figures that will in part explain some of the differences between the UK and Europe and will help you understand why we sometimes do things differently. There are a number of characteristics and cultural factors that affect investor and advisor behaviour. So let's look at the UK in the context of Europe. Firstly, the UK is the largest domestic market in Europe with assets of 1.1 trillion and one of the few markets that maintained positive growth in the wake of the financial crisis. To give you some context, it is almost twice as large as France and Germany and 6 times larger than the Spanish fund market. In terms of net fund flows, in 2015, the UK registered net flows of 21 billion euros. Only Italy and Germany did better. So what makes the UK market such a dynamic market? Well, it's mainly to do with pensions. Defined benefit schemes have been replaced by defined contribution pensions. We also have a low state pension, which is currently £116 a week. Tax incentivized wrappers also help. And new pension freedoms will boost the industry even further. But our distribution model is also a contributory factor to the dynamism of the UK industry. We have a multi-layered and complex distribution model, and there are a myriad of pathways from the end advisor through to the fund manager. We have several customer-facing channels that consumers can use. They are largely the same as yours, but the volume of flows can differ markedly. Financial advisors, wealth managers and private banking, insurance agents, banks and of course consumers can also go direct, either through a platform or direct to the provider. These customer-facing channels use several of what I call wholesale channels, and they aggregate the flows from the channels beneath them. Some will just use platforms and some will use all of them. Before RDR, the wholesale business was split between insurance, platforms and of course the fund managers themselves. But platforms offer a whole range of products and investments, including pensions, investment bonds and much more. They have eroded market share from the other two. Insurance companies have been demoted to being the providers of the various insurance wrappers that are sold on platform. So to stay in the game, they've had to reinvent themselves by taking the step of launching their own platform. So how much business does each channel do? In wholesale, platforms account for 40%, insurance aggregation for 15%, and the rest goes direct to fund groups. As you can see, the largest channel before RDR was the advice channel with 70%. Wealth and private banking accounted for 15% roughly, and the rest was divided between insurance agents on 8%, banks on 5%, and a small rump of direct business on 2%. But that doesn't really tell us very much. It also pays to know how much of the population actually had access to advice. These are our very rough estimates, but we believe that around 15 to 20% of the population had access to advice before RDR. Most got their advice through financial advisors and banks, and certainly the mass market was mainly advised by banks or bank advisors. As always, the wealthier segments of the population were serviced by wealth managers and private banks. Has anything changed since RDR was introduced? Well, the proportion of the population that has access to advice has fallen to around 8 to 12%, and it is the mainstream market that has been negatively affected. But even among the wealthier segments of society, there are some that do not want to pay for advice. As you can see, there is a much larger proportion of people that have no access to nothing. Nada. Zilch. Let me remind you that one of the objectives was for more consumers and not fewer to have access to good advice. So this is a key failure of one of the FSA's objectives, and essentially means that in the context of RDR, it has singularly failed. And we will explore exactly why this has happened later. Firstly, I want to show you how the channels have changed. You're probably expecting advice and wealth management percentages to have gone down. Am I right? Therefore, you'll be surprised to see that advisors and wealth managers are largely untouched. Indeed, they've probably gained market share, but I've kept it quite simple and left them the same as they were before. The real battle has been among the smaller segments. For example, insurance agents have seen their share shrink, banks have all but disappeared, and direct customers have grown considerably. Why? Well, banks were too scared to offer paid advice. They pulled out. Many of the old-style insurance and pension products could not be made RDR compliant, and so that business has also slowed. The growth in direct business was to be expected. Some of the direct consumers are people who used to take advice before, but have been disenfranchised by the system. But this is a huge issue for the government. It is not particularly proud of this. It recently introduced pension freedom, and it is now worried that consumers will not take advice and will spend their pension pots before they die, and once again become a burden on the state. As a result, it is conducting the Financial Advice Market Review, or FARMA, which has all the hallmarks of RDR2, and this is a joint review led by the Treasury and the FCA. The fact that it is led by the Treasury is a mark of the government's unhappiness.